Fed leaving its key interest rate unchanged, but did cite further progress towards that 2% inflation goal. And also, for some observers anyway, signaled a rate cut will be coming soon. Let's get more from Michael Green, Chief Strategist at Simplify Asset Management. Thanks very much for coming on the show.
Oh, it's a pleasure to be here.
I mean, it's always hard to read the runes here, but do you think the Fed did signal that it's prepared to cut rates September 18th?
I think Jay Powell did everything other than confirm that. He repeatedly attempted to deny that in the conversation, but it is very clear that he has moved in that direction. And this seems to be a foregone conclusion at this point. There were a lot of interesting components of the conversation. Again, his emphasis on data dependency and his introduction of the seasonality aspect are two new wrinkles that have been capturing a whole bunch of attention. That seasonality component is going to come into play later in the year, becoming less favorable. That actually raises risks that the Fed doesn't follow through as aggressively as the markets are currently priced.
I can't quite follow what you're saying about the seasonality there. Can you explain?
Of course. So the way that inflation is reported in the United States, we make adjustments for the expected level of inflation given the time of year. For example, in the summer period, oil price or gasoline prices rise as we change formulation for pollution control. That in turn raises the costs associated with gasoline. It would not be a measure of inflation to incorporate that regular seasonality. So we make adjustments for that. The problem that has occurred is the COVID disruptions, the shutdown and the reopening have substantially changed those seasonality patterns, such that inflation in the summers, because nobody was driving in those periods and oil prices, gasoline prices were depressed in the period of 2020 and 2021, we're looking at a situation in which those seasonalities have meaningfully changed. And as a result, the inflation that we're getting in the spring and in the winter periods are much higher than they would have traditionally been. The summer is depressed. The fact that he picked that up, I think, is a very important acknowledgement coming from the Fed that the data that we're receiving may have increasing inaccuracy associated with it.
That is interesting. Do you think the Fed is being too slow to cut interest rates? Is there a risk that America could even go into a recession here?
I think there's actually elevated risks that we will find out retroactively that America already is in a recession. Oh. So particularly if we look at broader measures of unemployment, the U6, which incorporates those who are working part-time for economic reasons, temporary workers who are no longer seeing their contracts renewed, et cetera, that has risen by a full percentage point over the last 2 years, really most of that occurring in the last year. Unfortunately, that data issue that I referred to before around the seasonality is affecting much broader components of the GDP and economic data that we're receiving. And unfortunately, that is subject to revisions. This is particularly true in the employment numbers, where there's a substantial disagreement between what's called the household survey, which is a survey of individuals, and the establishment survey, which you refer to as non-farm payrolls. Those have headed in somewhat opposite directions. Unfortunately, the data increasingly suggests that it's the non-farm payrolls that are really where the problem lies.
I mean, I always do think with such an incredibly complex entity as the U.S. economy, we focus on the Friday jobs number, and it always does seem very superficial. But in any case, I know people study econometrics for years to try to get around that stuff. But because we are seeing evidence, aren't we, from company reports that some consumers, particularly lower income consumers, are really hurting right now.
I think that is absolutely true. This is particularly true when we talk about lower income earners. So I want to distinguish between older households who generate their income off of assets versus those who gain it through employment. Mm-hmm. We've seen unemployment begin to rise rapidly amongst the 18 to 29 set. We're really starting to see credit distress begin to emerge in that group. That unfortunately becomes very caustic because if you encounter credit events early in your economic career, that delays everything from household formation to job portability, et cetera. Those are all very negative on a longer term outlook.
That's interesting. Apparently there's a movement in Toronto that senior discounts should be given to young people because they're hurting so much. And it is a theme we've heard, isn't it, that the young are having a really tough time, whereas a lot of seniors are pretty comfortable.
A lot of seniors are very comfortable. We've had a combination of full reimbursement, actually slightly more than full reimbursement through things like Social Security. I'm not as familiar with the statistics in Canada, but the second component is, again, remember that that older generation generates their income off of assets. By hiking interest rates, the Federal Reserve and the Bank of Canada have significantly increased the income that is received by that older generation where the wealth resides. That has enabled them to prop up their standard of living, while the younger generation that gains it through jobs is increasingly under pressure.
Yeah, we could talk about this all day. Michael, before we go, what would you be a buyer of U.S. bonds right now? TLT, one of the ETFs that tracks U.S. bonds. Is inflation truly controlled at this stage? Because obviously long-term bonds are dangerous if inflation comes back.
So I personally think that the inflation problem is currently solved. What I am in fear of is if the Fed, as I think, is far too late to the rate cutting cycle and has allowed credit to distress to bubble up within the economy, that we're going to create conditions that require an extreme response in the other direction. That in turn could create conditions that cause inflation to reemerge. That's the key fear that I currently have at this point. Now, with that said, I think that investors are well served by looking at particularly shorter term and intermediate term bonds, really that 2 to 5 year kind of belly period within the curve, recognizing that these returns and these levels of interest rates are artificially propped up. You should take advantage of that, capture the income where you can.